Hi class, and once again, welcome to the demo video for the Lessor accounting for the Lessor. This will be the last video for this learning plan, and in this video I will demonstrate 15-7, problem 15-7, and exercise 15-14. So let me just insert a few more columns in here so we have some room. Okay. So once again, I do have the amortization table for this problem just so it's easier to do our calculations. And this will be problem 15-7 on 913, page 913. All right, Neutral Labs Inc. leased a protein analyzer to Warner Chemicals Inc. on September 30th, 2013. Neutral Labs manufactured the machine at a cost of $5 million. The 5-year lease agreement calls for Warner to make quarterly lease payments of $391,548, payable each September 30th, December 31st, March 31st, June 30th, with the first payment of September 30th, 2013. Neutral Labs' implicit interest rate is 12%. So for requirement 1, we were supposed to determine the price at which Neutral Lab is selling the equipment, present value of lease equipment at September 30th, 2013 to the nearest 100. And we've demonstrated this a few times before. So basically we're going to calculate the present value of the lease payment, and it's required $391,548. So for 20 periods at 3%, our factor is going to be 15.32380. That gets us to a rounded $6 million. Okay. For requirement 2. Okay, we've also done this before as well, but I'll show you again for this one. We haven't done this too many times. Requirement 2. What pre-tax amounts related to the lease would Neutral Labs report its balance sheet at December 31st, 2013? Okay, so for our receivable at December 31st, 2013, our initial balance as of September 30th, 2013 is at $6 million. Okay. For our September 30th, 2000 reduction, it would be that $391,548. Okay. The second payment reduction would then be the $223,294. So as of December 31st, our net receivable, remember it's receivable now because we're doing the accounting for the person who owns the asset or the company who owns the asset, okay, would be, come on, there we go, $5,385,158. That is what they are supposed to report in their balance sheet as of December 31st, 2013. Okay? Okay, requirement 3. What pre-tax amounts related to the lease would Neutral Labs report in its income statement for the year ended December 31st, 2013? Okay, let's just list this as income effects year ended December 31st, 2013. Okay, we would report interest revenue. Okay, so as of December 31st, 2013, the interest revenue would be 0 because well, the first payment does not include interest or does not have interest. Then as of December 31st, 2013, interest revenue recorded for that amount is the $168,254. Okay. So our interest revenue for 2013 should be $168,254. Okay. That's requirement 3. I almost forgot something. For the income, we're going to report revenues, and we're also going to report sales, because this is for the lessor. So our sales revenue, okay, is going to consist of the $6 million, because that's what we leased the equipment for. And it said in the problem that Nutrilabs manufactured the machine at a cost of $5 million. So that would be their cost of goods sold for $5 million. Okay, that's what they manufactured to. It cost them $5 million, and they leased it for $6 million. So the income effect then would be the sum of these two for $1 million plus that $168,254. Okay. And I don't know why I keep doing this for that one, but let's see. No border. We just want a bottom border. Nope. Undo that. Top border. There we go. Okay. Let me just move it down a bit. Okay. All right, so basically for sales revenue and for interest revenue, we just had to add them together. So my total income effect would be 1.168254 added to net income. Requirement 4. What pre-tax amounts related to the lease were Nutrilabs reported statement of cash flows for the year ended December 31st, 2013? So we did this before, but I will go through it again. So Nutrilabs will report the $6 million. Which is the sales type lease of the protein analyzer as a significant non-cash activity, and the disclosure notes to the financial statements. Okay. Now we've got to also look at the cash lease payments. So the total is $783.96, or $783,096. What is wrong? Okay, so basically these two payments here, okay, are considered to be cash flows from operating activities. And remember that a sales type lease differs from a direct financing lease in that we assume the lessor is actually selling its product, and which is an operating activity. So both the interest portion, of $168,254 and the principal portion of $391,548 and the $223,294 are reported as cash inflows from operating activities. Okay. Double check here and ignore all. Ignore all. Yes, we're going to change that, change that, change that. Portion change. Okay. Typing too fast, and I do apologize for any other ones that do have spelling errors. Just, you can go ahead and do a spell check before you print it. Otherwise, I'm pretty sure you know what they are. Okay. So on top of this, and I just want to make a few notes to kind of just tell you about it. By the indirect method of reporting cash flows from operating activities, the $1 million dealer's profit must be deducted from net income because it is included in net income but won't increase cash inflows until the lease payments are collected over the next 5 years. So that 1 million right here, that net right here, okay, the 1 million in revenues. So this addition, however, occurs automatically as we make the usual adjustments for the change in receivables and for the change in inventory. And as far as the $168,254 interest revenue, that increased net income actually did increase cash. So for the $168,254, no adjustments to net income is necessary. And the principal portion of that $391,548 and the $223,294, they must be added back. They must be added because it's not otherwise included in net income. This too, though, occurs automatically as we make the usual adjustments for the change in receivables. So that's what that is for this problem. Okay, so if you have any questions, make sure to email me or give me a call. And once again, making this or creating this amortization table really helps in doing your problems. Okay, so what I'm going to do is I'm going to continue on to exercise 15-4. We're going to go back towards the book now. Okay, and exercise 15-4 gives us 4 different scenarios. And under each scenario, we are to calculate, we're to determine the annual lease payments for each. Okay, so basically, okay, it's on page 905. And what I'm going to do is I'm going to pause this and then I'm going to come back once I have that table down. I'm going to copy that the situations down first. Okay, well, this is what the problem gives us. Okay, they gave us 4 situations, 1, 2, 3, and 4. And for each situation, we're going to go through and determine the annual lease payments for each. All right. So let's start off with situation number 1. What we're going to do first here is we're going to list the amount to be recovered at the fair value, which should be the $50,000. Okay. Let me just make sure I do this here. Okay. Then we're going to, the lease payment at the beginning of each of the next 4 years going to be calculated as follows. Okay, we're going to take that present value of an annuity due of $1. So our number of payments is going to be, or number of periods is going to be 4, because it's lease terms 4 years. It doesn't state any specifics as I believe these are, the payments are made once per year. Yep, annual lease payments are payable at the beginning of each year. So our number of payments is going to be 4. And interest, then if you look, table 6 should be 10%. So factor is going to be 3.48685. So if I take my 50,000 times 3.48685, I should get hold on here. It's divided. I'm sorry about that. I knew something was going on there. Okay. So basically, we're going to take the lease payments at the beginning of each of the next 4 years, take that 50,000 divided by our present value of an annuity for a 3.48685, and we should get 14,340. Okay. So that is our lease payment at the beginning of each 4 years. That is our determine the annual lease payments for each, and that is what we're going to, that is the answer. Situation 2. Okay, so once again, amount to be recovered under the fair value is 350,000. Okay. All right, and so in this situation, we've got an amount that's guaranteed $50,000 from the lessee. They're saying that after they return that asset, after the lease lease is over, the asset will be worth at least $50,000. So if it's not worth $15,000, the lessee would either pay that in form of cash or, you know, of course, upscaling the asset to its worth of $50,000. However they want to do it, they're guaranteeing that once the lessee returns the asset, it's going to be at $50,000. So with that in mind, we have to subtract that present value of the residual value, okay, which is that 50,000 times the factor. So we're going to be using table 1. Number of payments or number of periods is 7. Interest at 11%. Our factor should be 4.48166. Okay. So if I take 50,000 times 0.48166, I should come to 24,083. Let me just do this. Table 1 using n equals 7 periods and I equals 11%. So that once you get to the homework, you remember where we got this payment factor from. Okay. All right, so my amount to be recovered through periodic lease payments will be that $350,000 minus the present value of the residual, and it would take me to $325,917. Okay. Okay. No border there. That's right. We're just doing this. Okay. There we go. Okay. I knew what I wanted to do. Okay. All right. Then basically what we're going to do is we're going to take the lease payments at the beginning of the year. Okay. So I'm going to take $325,917, which is what we figured here. I'm going to divide that by my factor 5.23054. And this factor, okay, so this factor comes from table 6. My number of payments equals 7. Interest equals 11% for a factor of 5.23054. Okay. So if I take my 325,917 times 5.23054, not times, once again doing it, divided by 5.23054, I get to $62,310 for my lease payment at the beginning of each year. Okay. So let me just highlight this so you guys can look at it and be able to see it easily. Okay. All right, and let me just put a freeze panes in here so that when I scroll up, we can see it. All right, situation 3. Once again, amount to be recovered at fair value is $75,000, right there. Okay. We're going to subtract the present value of the residual value, which is that 7,000 times the factor of 0.64993, and that factor comes from, let me just do this and I'll put it over here. Okay. It comes from table 1, using n equals 5 because there's 5 periods. Interest equals 9%. Factor should be 0.64993. Okay. All right, so that gets me to my amount to be recovered through the periodic lease of $70,450. Okay. Then my lease payments, let me just copy this here. My lease payments at the beginning of the year for the next, let's do this here. For the next 5 years, okay, is going to be the 70,450 divided by 4.23972, and that is taken from Table 6. Once again, we're going to look at the number of payments, number of periods, which is 5, and our interest is 9%. Okay, present value of an annuity due. So that means our factor equals 4.23972. So if I go in and put my formula in, 70,450 divided by 4.23972, my beginning lease payments for every year would be 16,617. Okay. All right, situation 4. All right, the amount to be recovered, the fair value is going to be 465,000 even. Okay. We're going to subtract the present value of the residual, which is the 45,000 plus, times our factor of 4388. Okay, and I will write that down once I have that in there. 45,000 times 0.40388, and I got that 45,000 from the guarantee by the lessee. That's lessee's making sure that it's going to be at least $30,000 worth when they bring back the equipment, and it's unguaranteed for that 15,000. So if something is unguaranteed, okay, if an amount is unguaranteed by the lessee, the amount of that 15,000 is going to be recovered from either selling, releasing, or otherwise obtaining value from the asset when it reverts back to the lessor. So those are the situations that they would have to do. However, they need to do it to get that asset back to that $45,000 residual value. Okay, so with this, okay, that's what I was going to do. It'd be Table 1 using N equals 8 periods, interest is 12%. I just want to be consistent with everything so we have it. Factor then is that 0.40388. Okay. All right, so with that, the amount to be recovered through periodic lease payments then is 446,825. So the lease payments at the beginning of the next year and for 4 years thereafter will be the 446,825 times divided by, I keep wanting to do it to multiply because we've been doing that for so long, divided by 5.56376. And that factor, once again, is from Table 6. Number of periods is 4. 8. Looking at situation 4 there. And interest is 12%. So that means our factor is 5.56376. Okay, so let me put my formula in. 446,825 divided by 5.56376 is 80,310. That is my lease payment at the beginning of each year for scenario 4. Okay. All right. If you need more information, once again, all this information or the reasons as to the guarantee by the lessee and the unguaranteed amount by the lessee is the reading is from page 879 through 883. So if you need more information on that, you can do that as well. And this situation then was for 4 different ones. Each one, number 1 did not have any guarantees or unguaranteed. Number 2 had a guarantee. Number 3 had an unguaranteed, and number 4 had a guarantee and an unguaranteed, in which we just added together, okay, to get the 45,000 here. So basically, this is exercise 15-4. This is the last exercise that I'm going to demonstrate for this chapter. Make sure that everything has been watched, or you can go over and rewatch it before you attempt the practice and graded homework. If you have questions, feel free to email me or call me.